Welcome back to Clear Perspectives with Marietta. I'm Mary Allmon, partner and portfolio manager. And today, we're diving into the global economy and markets as we kick off the first quarter 2026. Last year marked the third consecutive year of solid global growth and impressive equity market gains. Many of the trends that fueled last year's success still have momentum going into 2026. We expect global growth to continue at a steady pace, with the U.S. leading the way. The IMF is projecting global GDP growth of about 3.1% this year, and we're actually slightly more optimistic than they are. The major economies of the US, Europe, and China, they're all starting 2026 with easier monetary conditions and fiscal stimulus. A big question we have thinking about that is how these policies will look as we enter the second half of the year and look towards 2027. So that's something we'll be watching closely. Inflation in the US, it's still above the Fed's 2% target and will likely hover between 2.5% and 3%. But I think that's stable enough to avoid major market shocks. The bottom line, steady growth, strong earnings, and supportive policy, that all points to another year of solid stock market gains. In the US, we're forecasting GDP growth of around 3% for 2026. Consumer spending remains the backbone, while AI-driven investment will likely add some additional upside. But unfortunately, hiring has been very weak. We're coming to think of this as a laborless expansion. Despite that, unemployment will probably stay around 5% thanks to fiscal stimulus. Think lower taxes and higher defense spending, and a supportive Fed. Still, we'll be monitoring the jobless claims and layoffs closely. It's possible we could see some improvement in the labor market, but for now, this expansion is powered by spending and investment, not jobs. Equities are entering 2026 with solid tailwinds, economic momentum, 15% corporate profit growth, and lower interest rates. We think market leadership will likely stay concentrated in sectors tied to the AI supercycle. Growth stocks will likely continue to outperform value, and we think large caps, those will remain dominant. But I really want to add a note of caution. Crowded trades and narrow market leadership, that means less room for error. So valuation discipline, that really matters in this type of market. With the Fed easing and bond yields falling, liquidity is on our side, but we are keeping a close eye on the Fed's leadership transition in spring. We think this is a meaningful event that could impact investor confidence and create some market volatility. International markets crushed it in 2025, outperforming the US market for the first time in nearly a decade. The outperformance was driven by easier monetary policy, lower valuations, and a weak dollar that lifted forward returns for dollar-based investors. Our base case for the dollar is to trade in a relatively contained range of plus or minus 5% from the current level. And I think that'll create less of a tailwind for international equities than it did last year. Europe will see modest growth. China's slowing slightly, but adding stimulus. And India is kind of interesting to us, as it might possibly overtake Japan as the fourth largest economy. Overall, we're very constructive on international equities. Fixed income enters 2026 in a familiar place as well. The Fed rate cuts, that will pull down short-term yields, making money markets just a little bit less attractive, but heavy deficit spending will keep upward pressure on longer-term rates. We favor short to intermediate-term high-quality bonds for income without excessive risk. Credit spreads remain tight, so caution is key. If growth or inflation shifts meaningfully, I expect longer duration bonds to experience some volatility. So the takeaway, 2026 looks like another year of solid growth and market opportunity, but with nuances that you'll want to watch. If you found this outlook helpful, please let us know your thoughts, and we look forward to seeing you in the next one.